Chris MacIntosh, thanks so much for coming on the podcast.
Hey, thank you very much for having me, Frank. It's been far too long.
It's definitely been far too long. I mean, we've been so busy here. It's probably on me because when I go back and look, and I always do a ton of research on all my guests, even though I know them, I want to see what you've been writing for a long time. And just went back and looked the last time I had you on about, I don't say 15 months ago or 16 months ago, around there. Your performance from the time I've had you on, probably about 3-4 times over the past couple of years, I don't think there's anyone that has a better performance than you. And I want to start by talking about your methodology for picking stock sectors. And a lot of that has to do with asymmetric investing. Could you explain that in the easiest term possible, where you and I know what that is, but we also have a lot of listeners out there that are learning for the first time, listening for the first time, because it has a lot to do with your strategy and why it's not just you picking sectors, but we're going to go over the timing of how amazing your timing has been in certain in sectors and stocks and recommendations that you've given in this newsletter, of course, to your clients.
I'll do my best. Okay, so all right. Well, look, I mean, an asymmetric bet or an asymmetric investment is simply one that has a probability curve which is in your favor. So, whereby you bet $1 and the ability to make, say, $10 exists, and that doesn't mean that it's going to happen, but if you bet the $1, you get the $10, right? And if you get it correct. On the other hand, if you get it wrong, you lose your $1. Now, naturally, if you just think about it, you can do that 10 times. So your probability needs to be greater than 1 in 10 for it to over time work out. So that's just a sort of, if you kind of just think about probabilities, everything is just is a matter of probability. Now, what we do at Glenorchy Capital and the Insider program that we run, which is really just a derivative of the work that we do for our high net worth clients, is we'll look for these probability setups, and we don't look for it in particular equities. I don't really give a shit what an equity. There are doubtless countless equities out there that exhibit that asymmetric type of structure, but I'm not interested in those. Because I'm not actually a stock picker per se, and B, because I'm lazy. And what I mean by that is that I want to be in sectors which have the asymmetric setup rather than simply one equity. There's far too much risk in one equity. You can have one equity that looks like it has an asymmetric profile, and it could be as a consequence of that particular company having gone through a restructuring. Maybe they committed fraud, and so the stock price has been hammered. Maybe there's a jurisdictional problem in that it's got assets in some country that is now undergoing a coup. Like, there's any number of different things that can be particularly problematic for one particular company. On the other hand, when you find a sector that exhibits the same profile, then typically you're onto something. Now, so that's the first step, I guess, in terms of identifying an asymmetric setup. Then the second step, one which we use and spend a lot of time on, which is less scientific, I guess, is that we will overlay a macro outlook, a sort of geopolitical. We look at geopolitics, we look at geography, we look at a whole host of trends, certainly all of the fundamentals such as supply and demand and so on and so forth, technology, and we'll take this macro overlay, and then where that intersects with any sector that is on our radar, and at any point in time we've got probably 20, 30 things that we're looking at, but we don't necessarily invest in them. They just sort of sit there on the side, lurking, and they sit there, and we know that they're there, but we don't have sufficient confidence yet to participate in them until we feel like we can really understand why they exist in the first instance. Like, why does that particular sector look as cheap as it does? Because sometimes you get a value trap. so that's the first thing, is trying to understand why, like, where have you come from? If you don't know where you've come from, then your ability to identify where you might head to is next to impossible. So, what we do is then we where that macro overview or outlook intersects with existing asymmetric sectors, that is where we get much more comfortable, and then we'll start positioning accordingly. And then it's just a matter of risk management and position sizing across a portfolio, which is, that's sort of a separate topic, I guess, but it is one that is largely not dealt with by many, certainly not many newsletter writers. And really, that's just because it doesn't hype people up, and nobody gets super fucking excited about position sizing. But really, it is extraordinarily important. So that's basically how we go about constructing a portfolio.
So no,
Yep,
go ahead.
sorry.
No, I didn't know you're gonna, because I wanted to stop there because it's more. I don't know if it's right to say where asymmetric you could say is contrarian, because like you say, you're risking $1 to make 10, right? So in order to do that, which is a very low risk profile with super high reward potential, you have to look at things like you mentioned, things that you don't like, right? So, or things that are out of favor. I mean, things that are really out of favor that which, again, when you're looking at equities, which you say you're not really too concerned with, not too many things out of favor, valuations through the roof. But the last time I had you on, Chris, you talked about Bitcoin. It was when it came down to 4,000 and said it's going to go a lot higher. And I know you were looking at what's going on in the world. And you're one of the first people, I don't think too many people could say this, that you were talking about Bitcoin when it was $400. So, but the other call that you made, I was extremely impressed with, because I've been investing in gold. I've always had, I've been invested in private placements, but this is like 2016, 17. And, now, of course, a lot of these things are doing very, very well because gold's in a bull market. But in 2000, and I just said late 2018, you correct me if I'm wrong on that, early 2019, you started as, I don't know if it was the newsletter that you started, which was Resource Insider, where you said, listen, now's the time with everything going on with the government that you need to invest in gold, specifically junior. It looked like gold juniors and private placements, and you created this newsletter for accredited investors. But what amazed me was the timing on that, because you're not a gold bug. You really don't, you're not like, oh, you got to buy gold. And I get people on here that are just like, no matter what, 2012, 13, 14, 15, 16, buy gold while it went down. The timing on that, it couldn't have been perfect. And I saw the results of your portfolio. You sent me a snapshot, which is amazing. I want to talk about, when do you know is the right time? Because that's everything with every investment. I mean, if you pick the wrong time period, you could be right. If you're wrong on the time, you're dead. You're going to lose a ton of money. You may stop out. But how do you focus on the time when you're looking at that, especially looking at beaten up sectors like that?
Yeah, look, it's such an important question. And look, the first answer, Frank, is, you need to be humble, and you've got to realize that you don't know everything, and you've got to be very, very careful that you don't buy your own bullshit. Like, that's the first thing, So, but you mentioned something earlier, which was around contrarian. Now, I don't think of things as in that. I almost don't want to even consider whether something is contrarian or not. By default, when you find a sector which exhibits an asymmetric profile, it will be contrarian. How can it not be, right? It's just that's the dynamic that will exhibit itself. But I don't think I think it's important to not go about things and say, oh, what's contrarian out there? Let me go and look for that. I mean, I think that you certainly could come to the same, sectors, but I think the risk behind taking purely a contrarian viewpoint is that you miss out on all of the due diligence that you should be doing in order to get you to the same place. So it's a little bit like, having all of the muscles, but not having gone to the gym every day for 7 days a week in order to build that physique. If you haven't done the work, then you're not going to actually know when to get out. B, you're not going to know why the structure of that particular market looks like it does. And so really you'll end up being lucky, maybe, in terms of, investing in a particular sector, simply by sort of looking at things from a contrarian bet. So I don't like I don't like that word, basically, or at least not for my own, not for how we manage capital. So it's more important, I think, just to look for all of the underlying attributes that would get you to that asymmetric profile. Like I said, they will automatically be contrarian as a consequence, but there's a distinct difference. In terms of your timing, and you talk about gold and all that, yeah, I mean, I'm not a gold. I'll buy anything. I'll buy baked beans if that makes sense. I think it's important to be agnostic across what you're investing in. Certainly for a macro guy like me, I'm not a gold bug. I'm not like right now we are very, very heavily long commodities, but I'm not a commodity guy. And so coming back to Resource Insider, back in 2018, we started seeing a number of signs within the liquid markets in terms of currency flows and the valuations of gold across different currencies. At the time, gold wasn't moving in dollars, but we wrote an article for our Insider program, and we highlighted it, and we started dipping our toe for our clients at Glenorchy into gold equities. And the reason that we did it was quite simple. We had gold moving higher in every single currency bar the dollar. And so many money managers are far too US-centric. They're denominated in dollars in their portfolios. They're often American by citizenship and so on and so forth. So there tends to just be this inherent bias with respect to how they view any market because they're denominating it in dollars. And it's important to look at things from multiple angles. So when we did that from multiple angles, we could see that something was happening. That was coupled with the fact that we had resource markets are cyclical. So 2012 roughly was the last high, and so we've had a pretty decent, I would say, fairly brutal bear market ever since. So for all that time, we weren't short, but we were certainly not long. It just made no sense to be investing or diving into a sector which has just come off of multi-year highs and is clearly topped out. And so, and especially knowing that it's a cyclical sector. So coming back to the private placements, if you just simply take a look at where your most asymmetric returns tend to exist, certainly at the sort of first and second innings of a commodity bull market, they exist in the private placement space. That's as a consequence of the timing that you have with respect to capital coming into a sector, demand exceeding supply. As you know, Frank, you want to get a mine up and going, it's going to take you a lot more than a few months. And so there's this gap and a window whereby the price moves and the underlying supply does not come on quickly enough in order to satiate that demand. In that space, you have companies scrambling to go and meet that supply gap, and so it's just that's the structure of the market. So that's where the returns become the most. Now I don't know a bloody a hole in the ground from anything else, and so I needed to find somebody that was a technical expert in that space who had exceptional contacts. And so back in actually 2017, I started looking, not intending yet to do anything because I didn't feel like I could. It felt like we were getting to the point where it would become a time to take advantage of it, but I wasn't rushing. I did have a lot of struggles to actually find someone in the sector or even find another newsletter or something like that. And I just wanted a no bullshit technical expert, and I after interviewing for over a year and discarding probably 50-60 applications, I came across Jamie, who got introduced to me through another gent who I really actually wanted to bring on board, but has another gig at a mining company, and I couldn't entice him away. And so we got introduced, and long story short, he's a rock star, and so that's worked out really well. But the timing was really a matter of just looking at this underlying structure of that market. And then the thing that you got to remember with respect to precious metals is that they, gold, silver, they move when you begin to have a loss of faith in the currency. They don't move as a consequence of money supply, for example. I know that a lot of guys will rant on about that and they go, the money supply is doing this and this and that and the other thing. That is a underlying driver, but only once the populace, once people figure out what the consequences of that could be, do you then have a loss of faith in the currency, and then those precious metals tend to outperform. The other thing to consider in that is also the way, so for example, you can have your monetary aggregates like M1 and M2 expanding in credit and that hasn't had any real impact on inflation in the money in sort of CPI, I guess. So if you go back to like 2008, you had the Fed's policies. They were bailing out banks. They bought mortgage-backed securities, asset-backed securities. But the thing that they started doing, and now they're doing at an accelerating rate since COVID, is about corporate debt, junk bonds, CLOs. They're buying everything. And actually, they're now, and this is really important, they're making primary loans to businesses. So this has never been done before. The Federal Reserve has never made a loan to a corporation. They used to just buy debt in the secondary market. And this is important because the Fed's actions in the fiscal policy, which isn't basically an end run around banks, what you're doing is you're sending money directly to consumers and businesses. And that means that your broad monetary aggregates of M1, M2, and M3 are actually expanding rapidly, not just your base money supply, not just Fed credit. Those broad monetary aggregates are exploding in size. And in the context of an economy that's increasingly unproductive, this is basically stagflation. And what it brings with it is a loss of faith in all sorts of things. When you have an unproductive economy, there's social ramifications, which we're seeing. You have inequality starts accelerating. You have, and we've seen this now, increased calls for socialism / Marxism. All of those things are extraordinarily beneficial for stuff, I would say. And at the top end of stuff is gold and silver. So it's a very long way of answering your relatively short question.
No, that's great. That's great. So, Chris, now here's the big question. You sound, based on what you're saying, you see that entire market when you're looking at gold, and you just talked about the dynamics that are going on behind the scenes. We understand central governments are going to continue to spend. COVID, I don't think anyone's really factoring in that this is pushing into 2021 now. It was supposed to be a second half recovery. So one is, you nailed it. You showed me your portfolio, which is up around 125%, I think, which includes 12 resource names that you got into, which is unbelievable. But I have to think you would hate this now, because when you like gold, and again, it's not that you're looking contrarian, but when you like gold, not a lot of people are talking about it today. The world loves gold and talking about it. I know you're not looking to maybe, you can hold on to your portfolio. You were in early, but are you still seeing ideas in this industry that you want to invest in? Or is it, here's a trade that worked out. It's probably going to work out a little bit longer, and we'll just hold the, what we have.
I think it's got a long ways to run. If you just look at the structure of the market, firstly, we're coming off the lows of a cyclical bear market. Those don't typically, solve themselves within a 6-12 month time frame. That's the first thing. They tend to be, it's a cyclical market. So we've from to the next high, and I think that we have the potential for this one to be in order of magnitude greater than previous cycles. One could easily make the case that we've got at least a 5-year time frame. Our portfolio is structured such that we have, for the chaos that we see coming in the next few years, we're very, very heavily positioned for that. coming out of that, we have what we believe to be, how do I put this? We're in the cusp of watching the West lose to the East. But the first phase of that is a chaotic phase. It's oh my God, I don't know what the hell is going on. I need security. I need something of stability. And what is it that I buy? It's not a matter of trying to figure out where's the growth in the world. How can I turn $1 into $1.20? It's none of that. It's shit, I don't want to lose anything. I'm already losing. Things are really getting hairy. I'm really afraid. What do I do? So that's the sort of chaotic phase. In the process of that, there's a number of different things that I've been writing about, whereby both in terms of bureaucracy, in terms of geopolitics, a whole host of different things, we are seeing the capital, and especially the intellectual capital in the world, increasingly shifting to the East. That, I believe, is going to accelerate, and we are very cognizant of that and watching that, and we'll be looking to start taking our gains from what I would sort of determine as a chaos type portfolio and deploying them into where the brightness in the world is likely to exist going forward. And I will probably be about 2 years too early, but I'm quite comfortable with doing that. And so that's how we're viewing things at this point in time.
So you know as well as I do that when you have something right, your clients, subscribers, your high net worth individuals, they're high-fiving each other, Chris, you're the best, and that ends pretty fast because all they want to know is what's the next big idea. I get that all the time with my newsletter subscribers. Okay, what's going on? We did great with this. Where's the next place? Are you finding anything out there? And I know you said you don't care about the equity market, but I did notice something inside your portfolio where you took two positions. It was in the same stock, but I think different time periods in lithium. I mean, when people see lithium, they think, electric cars, or, maybe that's it, or is, that considered like your commodity theme, or is there something else out there? Because you've been known to give us ideas and share ideas with me that are so far off the radar that I love that you're not going to hear everybody else anywhere else. So I'm building this up really good. I'm hoping you have something for us. If not, I understand. But I'm just curious what you're looking at now.
Look, I think right now, if people want to have a truly asymmetric bet and they've got a long enough time frame and they are patient and they know how to position size, think of energy. Energy is going to be absolutely spectacular. Probably for the next couple of years, it's going to bump and grind, and it's just going to be boring as hell, and no one's going to care about it. But energy is going to be truly spectacular. So I'm doing a number of things in that. One was just on a personal basis. I was going to go out and buy, with a couple of hedge fund buddies, some apartments in Dubai, which is a synthetic coal and oil. Yes, I'm aware Dubai is only about 4% of the GDP comes from oil, but it's actually the hub for Middle East energy. It will continue to be. There's a whole host of things. I won't get into the whole sort of Dubai thing, but it's certainly been absolutely hammered because it's run on two things. It's run on the synthetic oil positioning where it is in terms of it's kind of like the Switzerland of the Middle East. And the second has been conferences and tourism, both of which have been decimated. And so, but on a go forward basis, it presents extraordinarily good upside. And so I'm going out and investing in that. Not quite, I'd sort of put it out to subscribers. A lot of guys thought it's a wonderful idea, so I'm probably just going to put a vehicle together in order to participate in that at a sort of bigger scale. That's one thing that people can just have a think about is energy. Energy is also going to bifurcate. It's going to become much more localized. So there's going to be extraordinary opportunities in particular jurisdictions as supply chains break, as the US steps back from its policing the world structure that it's been enjoying since Bretton Woods. We're going to see a power vacuum open up, and we're going to see a lot of different changes, especially within the energy sort of bracket. And so I just put energy on your watch list. That can include everything from uranium to coal to lithium, to oil, of course, and natural gas. So all of those, if you kind of think through a stagflationary environment, all of those are actually quite beneficial asset classes to be invested in anyway. Yes, I'm fully aware that we have a massive supply glut in oil, but so is the market. That's not a surprise to anybody. Also, we have this extraordinary setup whereby demand has been hammered, and the increasingly the uncertainty in terms of when that demand may come back with any real vigor has really massively weighed on the energy markets. It's set ourselves up for just a pretty phenomenal play. So that would be my my tip, I guess, if you want to call it that. I don't really.
No, I mean, I love that because for me, especially in today's world, right? I mean, with politicians, at least in the U.S., because we're doing this New Zealand, which is amazing that we have this kind of technology to do this kind of interview. But it's always, when you disagree, you hate the person, right? So for me, when I look at energy, I'm kind of looking short term, like you saying, like you mentioned, where, where's demand going to come from? Everything's shut off right now. We have huge supply in the market. But just to hear that, it makes my wheels start turning. Okay, yeah, it does make sense. It is going to work out. And we're so short term oriented now, right? I mean, with the markets, it's kind of amazing that a year holding something for a year is like you're a dinosaur these days, right?
Yep. And that's where your edge actually exists. The other thing that you can think about, Frank, is that oil, like, look, when we had the oil spike in the 70s, that the global oil supply was it was sufficient. There wasn't an issue with respect to global supplies of oil. What happened was that we had a setup whereby access to supply was curtailed. Have a look at the geopolitical world today. Just have a look, stop and think, and run through the probabilities, and then reassess the entire framework. We don't need to have a supply destruction in respect to oil for it to spike. Although we are getting in just incredible supply destruction. I mean, Venezuela was gone anyway because they went down the Marxist route. Shale's pretty much gone. Nigeria is shut for business. Mexico's screwed. I mean, this oil war between, conducted essentially by the Saudis and the Russians, is absolutely decimating so many producers, so much supply. And that supply is not going to be turned on in a month or two. It is going to take a lot to turn that supply back on. So we're seeing in just incredible supply destruction and incredible concentration of power in the energy markets right now. People aren't paying attention to this. They really should. And you couple that with the geopolitical uncertainty that goes along, trade, tariffs, you name it. The probability of us having a curtailment of access to oil is much, much higher than anybody anticipates. Now, I'm not saying that happens. Again, you can look at this from a longer term time frame. And when I say longer term, I'm happy to sit down and say, okay, what's this look like in 5 years' time? What's my probability ratio? And how do I participate in this? And then what is the cost to participate? I mean, right now I can buy assets for less than it would cost to actually go and build those assets. Like if I'm thinking about Dubai real estate, which is a synthetic call. Now, and then we've got another, not so little factor, which is that all of the dollar peg countries in the Middle East are under extreme pressure because the FX reserves are collapsing. People need to have a look at Oman, Qatar. The potential for us to have an emerging market sovereign default in the next 6 months, I think, is absolutely extraordinarily high. Whether that reverberates through and starts a knock-on effect like we had in the 97 crisis in Asia, time will tell. But if that happens, oh, wow, I'm going to be just over the moon. I'll be looking to buy assets for cents on the dollar at just extraordinarily cheap prices. with a long-term view where I think I can make many, many multiples on my money.
Well, definitely makes sense, Chris. And I have to say, what I really love about you too is you're not one of those guys out there where, especially in my industry, newsletter industry, I mean, people look at me, I'm trying to change that, where the perception is just all this hype and marketing. You're a guy that's, here's my results. If you like what you see, follow me. If not, I don't care. So for me, I love having you on, and I'm sure people listen to this saying, wow, this guy makes a lot of sense. If they want to find out more information about you, read some of the things that you write, and how could they do that?
Well, I write a blog at Capitalist Exploits. You can go there, capitalistexploits.com or .at. And then for institutional and high net worth clients, we have Glenorchy Capital. That's just glenorchycapital.net. You can find me on either of those. And that's it.
Well, that's great stuff. Well, Chris, listen, we can't wait this long to get you back on the podcast. It's funny, a couple guys asked, I'm like, man, when's the last time I had Chris on? So that's on me. I'd love to have you on every few months and pick your mind, because you always make me a smart investor, and I love some of the ideas. The ideas I get from you, I don't hear anyplace else. So I really appreciate you taking the time. I know it's a big time differential, so I appreciate that too. And yeah, we'll definitely have you back on soon, but I really appreciate it.
You're far too kind. You make me sound like I'm much smarter than I am, Frank.
Not true, buddy. Not true. Not true at all. I mean, based on your performance, no, that is definitely not true. So we'll definitely talk soon. I appreciate it.
Good chatting. Thanks, Frank. Take care.